Paul Ashworth, Managing Partner from Cameron Harrison, is standing by. Paul, great to see you. Been a little while since we have chatted. Just wanted to get your view on this kind of, well, central banks or the Fed in particular might have paused. It's time to load up on risk. What are your thoughts there?
Well, we certainly believe that rates will be higher for longer. Our consistent position over the last 6 to 8 months has been that we do view that the Fed, as with the Reserve Bank here in Australia, they want to get to a point where inflation is meaningfully, in a controlled range, and it's not at the level that it currently is. And as we know, inflation is one of the last measures, in the cycles. So that does concern us. It concerns us, in the fact that particularly in Australia, where we see sectors and of the economy that are already in recession. We see the state of the household. That together with the data that they draw off, we've seen in the UK in terms of the MPC, just the criticism that they're coming under in terms of their data models by Mervyn King in the House of Lords. Mervyn King, of course, being a prior governor of the Bank of England. There is this certain belligerence, notwithstanding data, that the only data that they're interested in is that inflation figure that they seek, and that will be the last figure that actually proves their position. So that does not augur well.
Indeed, it does seem precarious, at least for economic fundamentals. And I wanted to bring it back home to Australia's economic fundamentals because, well, the economy's proven fairly resilient, robust. Of course, we've had our certain issues, especially with cost of living pressures, which arguably is coming because the economy is running so hot. But there is this sense that we're heading to some, well, pretty rough times ahead, especially when it comes to households. How are you seeing the unfolding situation?
I think that's a good point, Carl, because from an aggregate level, the economy it's not going well. In a historical context, it's getting through. But what we're particularly drawn to, which is something that we've been drawn to from, if you like, from the GFC period through to COVID, is really this measure on a per capita basis. Is when we actually start looking at these aggregate figures on a per capita basis. What does that mean? And certainly, when we look at government receipts, is obviously is a key one. Population growth, and one of the figures to look at is really that population growth for those aged, or in terms of immigration, over 15 years of age. That's running close to 500,000 people over the course of the last 12 months. So of course that's that's great for the if you like, for the non-discretionary part of the economy. It's great for governments in terms of GST receipts, in terms of income tax receipts. Fantastic. But in terms of household income, it's absolutely horrible. And when we look at it on a per capita basis, it couldn't be more horrible. When looked at over the course of the last 45 years. So, we say that soundly say that the household is in an income recession. And yes, I think we all agree that in terms of the rate cycle, we're at the we're closer to the end than, of course, rather the middle or the start. But one of the things that really does concern is as we approach the end, what does the journey look after that? And we think the journey, going forward over the next 3 to 5 years, is particularly dismal for households. It's particularly dismal in terms of the level of debt that they've got to finance, which is materially up. On average, it's up 46%, in the last 5 years. We've got high levels of debt. We've got high levels, obviously, of house price. We have, obviously great concern that, once, inflation really does moderate, we've got households sitting there with no wages growth. We've got continued immigration growth, all pushing down. And, you've brought that up, there, Carl. On the grey line there, you can see that per capita real disposable income growth. It is dismal. And the problem that we foresee is it doesn't get, of course it'll get better as inflation moderates, but getting better to, rather than negative growth, just to be no growth. And I think we just got to be mindful, particularly in terms of the banking sector, and this is particularly focused to Australia, that the banking sector faces a lot of zombie borrowers with little equity or negative equity in terms of their mortgages, particularly for vintages from about 2020 onwards. And we can see in terms of the RMBS data, in terms of the 2020-21, the 2021-22 RMBS vintages, the arrears are starting to get up to GFC levels. So we can see that the pain's there. It's flowing out. But as I said, what concerns us is, once we get to that easing cycle, yes, there'll be some obvious respite for households, but with an outlook of no real income growth, not great for residential property, not great for banks going forward.
So let's talk about the investment implications of this thesis, because I guess if I was to just sort of pick up on themes that, as a naive sort of layperson observing this every day, the retailers getting swamped, the banks are kind of struggling a little bit. There's this argument whether now is the time to reallocate into fixed income assets on the basis that maybe we've seen a peak in the rate hiking cycle. All those things are sort of whirling around because of some of the themes you've just outlined. So, I mean, for you, the portfolio implications, what are they?
Okay, so if we look at equities to start with, Kyle, we have a strong preference for developed smart industrial businesses offshore. That is where the size, it's where the competitive advantage exists. It's where the productivity in those businesses exists. We find it difficult to go past the US economy just in terms of its productivity performance. In Australia, we'll be talking about seeking productivity improvement. We'll be talking about it for not just the next 5 years. We'll be talking about it for the next 10 years. Yet it's being delivered in the US. So we see those smart industrials that just grind out productivity improvement year in, year out. So that's probably the first thing I'd note. From a property perspective, yes, we see that there are elements within property, that link quite nicely to to where population growth is. So we think governments, they're addicted to population growth. They can't get productivity growth, so they'll have to get population growth to actually grow, to grow receipts. And then that's really unofficial. It's really a bipartisan position. Both sides of the political spectrum in Australia, favour that position. So to that end, we do like, from an equity perspective, we do like the non-discretionary side of things. And from a property perspective, we like the assets that support that population growth and that aggregate demand. So we do particularly like industrial property. So that's really the next point. And from a fixed income portfolio, we do see that inflation will moderate. We do see that bond rates, and particularly for some fixed components there, operating at triple B plus, A minus, type subordinated bank debt. We do find that attractive, around the 6.5% levels. So we think that represents good value in an environment where inflation will moderate. And longer term bond rates will start reflecting that. So that's a point that you made earlier, just in terms of the 60-40 model. We see value in that 60-40 model, but within the 40 and then within the 60, it needs to be quite discerning.